you're interested in checking out TradeNet, they currently have a sale on their base package, the intro package, where you can get it for 30% off at $350. And that package comes with a funded account with $14K in buying power with a $700 max loss. But there's no PDT rule, and so new traders specifically can day trade as much as they want without necessarily risking what they would if they deposited thousands into a regular broker. And so for new traders, I think it makes a ton of sense. And if you're interested in checking that out, I'll include a link as well in the description. And so thanks for watching and enjoy this video. Support and resistance is used to calculate levels in trading. Trading really is all about different levels. You know, these levels are used to base your trades around and to be your guide while you're in the trade. We always talk about, you build this plan around each trade you get into, and this plan is typically based off of support and resistance levels. Now, where's your risk? That's going to be typically a resistance level or a previous support level. Where's your reward? That's usually going to be a previous support level. And so you use these levels in support and resistance to base your trades off of. And there's kind of a natural progression in stocks, testing these levels, going back, so forth and so on. And so we'll go over that a little bit later. But the first thing I want to touch on is that the more volume a stock has, the more defined the support and resistance will be. Because of that, trading stocks with decent volume is usually important, especially if you're day trading. Volume is super important because if not, those levels aren't going to be evident. You know, you're not going to be able to see those levels as clearly. I think I've gone over it in a previous class. And it's really easy to just get squeezed out of a trade. You don't understand the levels. You don't know where the levels are. And so just to give an example of that, here is a stock that had decent volume today. It was QD. It has some very defined and obvious levels here. If I put my mouse here at this arrow and go over, you can see all the resistance at that level. Same thing for this one. Very defined. I can put my mouse over and you can see the stock runs into those levels multiple times. This is decent volume. It's not perfect volume. It's not huge volume, but it's decent. And it shows you that with decent volume, you can find some levels to base your trades off of. Now, if we go look at a stock like, what was the stock I used as this example? I think it was MTSL actually. If you go look at a stock like MTSL, this is what it looks like. And it's really hard to base your trade off of these levels because there aren't really any levels. It's just chop. It's just gaps and chop, and there's not much action here. And you need volume to make those levels defined for you. And so it's really tempting to see a stock with no volume, even if the setup looks great. Even if it's following your setup to a T, it's really tempting to jump in the trade, but you need volume. But the next thing I want to go over is half and whole dollars. They are reinforced in our minds because they are easier to calculate and give us round numbers to analyze. And so if you think about that, that's usually why half and whole dollars work, is because those are levels that people are specifically locking onto when they look at a chart and its price. And like this says, it's because they're easier to calculate. It gives us round numbers to analyze, really easy numbers to add up. And so people latch onto those levels and kind of lock onto those levels. And because of this, many times these levels act as major support and resistance in charting. At the same time, you still want to look for confirmation, which you'll usually find in the historical and intraday chart for these half and whole dollar levels. And just to give you an example, you can honestly, guys, you can do this with any chart, right? If you go to any chart and you look for a stock within the range of these half and whole dollars and you just draw a line at these half or whole dollars and just look.
What those key levels are going to give you, it's going to give you an ability to attack a range. If you're not attacking a range, you're not going to be able to increase risk and reward. And so that's really why we attack ranges in the first place, is that the closer you get to a risk, the better you're going to have that bigger reward for the bigger kind of swing of the kind of range. And so there is, of course, a bunch of reversals in between these patterns. But if you attack ranges from the top to the bottom, you definitely will always increase on that accuracy because what you'll get is the bigger profit in the long run.
Using these levels in trading. So trading off of support and resistance is key. You always want to map out the pre-market and historical levels before the open or before trading. This is when you will be the most objective about these levels, and thus will have more objective data. If you're not as objective, if you're in the trade already, you're going to be kind of wanting to will the trade. And there's exceptions to this. Like, for instance, if you've already taken profits and you're in between and you have to give yourself a new risk, that's fine. But you want to map these levels out before you get into the trade, because if not, you're going to kind of morph them to fit what you want. And that's not the most objective way to do it. And so you just want to do it before you get into the trade. Be objective, be honest with yourself about these levels, because those are going to be your guide, and you want to be as honest and as accurate as possible. You can look for 2 or more touches to these levels before establishing them as support or resistance. That way other traders are going to be watching them as well. Like on this, for instance, you can see it tests this level numerous times, and so you have a very obvious and defined level to watch in this stock, but you can map out these levels and understand these levels as well. Alright, so like this says, letting these levels guide your trade. So support and resistance levels are meant to be your guide, and you use them by following the evolution of the stock on that particular day. In other words, you let the stock test and break those levels. If so, the support or resistance should be flipped, meaning once the break, previous support turns into resistance and vice versa. And once that happens, you look on to the next level in the chart to watch out for. And these levels can be determined in your pre-trade plan, but you can also use previous moves to determine your new risk as the trade progresses. So does that make sense to everybody? So typically, especially if you're a very new trader, support typically turns into resistance once the break happens, and vice versa, resistance turns into support a lot of the time once the break happens. As with anything, like Mitch went over yesterday, trading's based off probabilities, and so it's not always going to work 100% of the time. But a general rule of thumb is that once the break happens, previous support turns into resistance, and previous resistance turns into support. And so to approach it, like I said, in kind of that progression state where you look for it to break, maybe it bounces, maybe it breaks. If it does break, you look for that previous support to turn into resistance, keep going down. Look for it to test the second level. If it breaks, great. Look for that previous support to turn into resistance, and then you can just kind of progress in the trade. The stock progresses during the day, and you have these levels to analyze and watch out for. All right, so here's an example of today's trade. I believe it was today's trade that I was in. So I got into a trade today on CRON. But the natural progression when I was holding this stock is that you could see the previous support. You can see the stock test this previous support here. And then we finally get a break and a hold. Once we finally get this break down here, we finally get this break, and it's not putting in any higher highs or anything like that, then we want to see that previous support here, which it confirmed it here, here, and it tested it a few times here. We want to see that area turn into resistance. And that's exactly what you get. And this happens so much in the market. And this is kind of why today I'm really trying to stress this is the natural progression of stocks. Lower highs, and then once it finally breaks over a big support level here, you want to see that support level turn into resistance. And even if you're just trying to scalp these type of moves, or you're trying to trade a different strategy than we do, the closer you enter that position to that support or resistance, the better your risk and reward is going to be. And so what we mean by that, okay, so the closer you enter it to this level here, you can all see this level, this red line right here. The closer you enter it if you're going short, the closer you enter it to that level, the better your risk and reward is going to be. Because, you could set either this level here as your risk, this level here, and it's going to be really tight. And if you're going short, the closer you get into it relative to the resistance. If you're going long, the closer you buy it to previous support. The better your risk and reward is ultimately going to be. If you enter the stock here, set a risk here. If it breaks this level, that's your cue to get out the trade, and your risk is tiny. But if it washes out like it did here, you have a much bigger reward. And this is kind of one of those ways that you can get good risk and reward, and kind of use risk and reward to just guide you in finding a strategy as well. All right, so just to show you, I entered this stock here at the VWAP right here, at this purple line right here, and I was holding it through, and I was pretty confident during this entire move down. And there's a few different reasons why I was confident during this entire move down. The main reason, like I said here, is that it has this resistance confirmation here. And so you can see here, the stock is continually putting in lower highs, lower highs, lower highs, lower high, and then it has this big confirmation in this support and resistance level. And so, for instance, one thing that you want to see with support and resistance is you want to look for confirmation. Confirmation is my favorite thing in the world when I'm trading, because it makes my trade extremely easy to follow. My guide is super simple because it confirms the levels I have in that trade. And so, for instance, say this level's your risk and you enter it here and you're trying to maybe take a bigger move. When you see the stock push up to these levels and test it, let's count. See, it tests it 1, 2, 3, 4. It tests it 4 times within about a 20 or 30 minute time frame, and every single time it gets rejected. That's my favorite thing in the world, because at this point in this trade, I can set that level as my risk, and I'm very confident in that level because it's tested it so many times. Not only was it resistance here, but it was support here, that the trade is really easy. It's confirmed my level multiple times. And so if I'm in this trade, like I said, I got in the VWAP fade here. By this point, I'd already taken some profits. I'd already scaled out a decent amount. And so when the stock drops here, where you're taking the next profit, when the stock dropped here, off of this support level, and I can take my second profit, the rest of the trade is extremely easy. Why is it easy? Is because it confirmed a very obvious risk level for me multiple times. And all I have to do is follow the guide. Like I said, you let support and resistance guide you in the trade. And so in this case, it was showing me that this level was major resistance. And that if the stock breaks over that major resistance, that's generally going to be my cue to get out of the trade. If the stock stays under that resistance, then I can stay comfortable in the trade because I know it's still not putting in any higher highs. It's still under that big resistance level. It still hasn't been able to break it. And so it's still essentially in a bearish or downward trend because it still can't break that level. And this is kind of the natural progression in this stock, right? So if I'm holding, and this is the trade I made today. And so I was holding it with this VWAP fade here. Held it all the way down to this level here. And at this point, I was wondering, where's my guide when I'm actually trying to take profits? Where should I take profits? What should I do here? And you can see, once it puts in a new low here, and it's very obvious, then I can give myself a new risk. And so, when a stock gets down to another support level, so when the stock drops here at the low of the day, I can take profits again. And then, since it confirmed this level multiple times, here, I can use that level to really guide me in this trade. I take that third profit down here at the previous low of the day, then I can give myself a lower risk now. I can lower my risk down. And so I can, instead of it being up here, like we mentioned before, when I took profits at this level, you can see this was my risk. I can lower my risk down to this level once it actually breaks under and touches this previous support here. And so can everybody see how you can kind of use support and resistance to guide you in the trade? There's a natural progression of the trade if it continues to go in your direction. And you can use these support and resistance levels to kind of map out what you're going to do next. How you're going to approach the trade, limit your risk, and give yourself the best odds of success in those trades. Is that it is okay to let the stock test these levels. And many times it will. It's okay to let it test these levels, guys, because it's probably going to. And that's the point. But when a new candle opens up above those levels and it breaks really clean, that is your reminder to get out the trade. If setting stop losses, one thing I do, and one of the reasons I really I don't set physical stop losses, and this is all subjective as well, people have different preferences, but one of the reasons I don't is because a lot of the time the stock is going to test these levels. And if I stopped out every single time it tested those levels, my accuracy rate would be terrible. Because a lot of the time it will test these levels, guys. That's just kind of why it's a level. But you want to wait for it to actually break clean from that level before you actually get out of the trade. And like this says, if you're setting a stop loss, you can compensate by setting it 1 or 2 cents higher if you're letting it test. But this is all subjective. Kind of find your sweet spot, I would say, if you're doing this method. Because if you do let it test your risk and it gets rejected or bounces, so meaning it gets rejected when you're shorting, which is a good thing, or it bounces when you're long, and that's a good thing, you can then use that high or low as your risk confirmation. This makes following the trade guide easy, and it should make you more confident in your risk level, especially if it confirms that risk level multiple times. You might be a little nervous as it's testing your risk level. You shouldn't be, because all you should do is follow your levels. But if it tests that level multiple times and holds, then you should be super confident in that level. Your trade is completely mapped out for you. If it actually breaks that level, very easy exit from the trade, because it has tested it and confirmed it numerous times. And with that, you have a very, very self-evident level to follow.
When it comes to risk, you want to keep it as specific as possible. One of the key things is if you are holding it to a key level and you feel like you're getting stopped out because you're kind of not letting it go completely to that level. One of the key things, you can always give up one more cent. There's always what we call slippage, and really 1 cent's really not going to kill you. The real key is understanding that you're not going to give yourself, another 10 cents, another
Right.
5 cents,
Right.
even 3 cents.
Right.
1 cent, you lose 1 cent, that's 1 cent. That's being reasonable as a trader and kind of a variance there. Or you can just actually set that as your actual, like, your spot, that no matter what, if you see that number, you're getting out.
Right.
And that's your maximum.
Right.
But one of the real keys is keeping that really like consecutively right behind the risk point, because you should understand that if you see any big sizing, it can always push through fast.
Right.
So you don't want to ever get caught in a really big squeeze. The only way you ever avoid that is if you don't give yourself that, maybe let me give it 2 more ticks.
Right.
You can't do that. You have to go ahead and just take the trade off, realize how many times you can just go right back in a trade and make the money instead of just staying at risk.
Right.
Remember that you're just at risk. You can
Right.
lose a lot of money if you just stay in the trade versus getting out and then taking another one.
Right. You can immediately exit and get back in, and you don't really lose anything in that trade. Now, you're going to lose what you originally risked, but what I'm saying is the trade's not going to be any worse for you if you get out and back in. The only thing you're going to lose is commissions. But that's why I said, like, if you want to set your risk 1 or 2 cents higher to let it test, that's fine. And that's something I typically do, because a lot of the time it's going to test these levels. And like I said, I'm going to go to an example here of this specific trade today for Cron. When I was in this trade today, and I think I was even talking about this risk level before I got into this trade during the stream today. But when I was in this trade, I gave myself 11.52 as my risk. Why was 11.52 my risk? Is because you could see, boom, you can see this level here. It confirms it here. Very obvious 11.52 risk level. And you can see this stock beautifully confirmed my risk level. Let me make sure you all can see that. This stock beautifully confirmed that risk level here. And it got to 11.52. And so if I would have set 11.52 as my risk and just said if it touches 11.52, I'm going to get out the trade, then I would have been stopped out right at the top here. And so to compensate for that, I can give myself that 11.53, 11.54 risk level, which the chart actually aligns up with. And that way it can test the level. But if it actually breaks clean, I'm out of the trade. Specifically, if a new candle opens up above that level, I'm out of the trade. But I have to give myself a little bit of room to let it test that level. And like I said, if I have to compensate with my risk being a few cents higher, I think that's okay. But you have to you have to set that level as your risk. You can't give yourself, like Mitch says, you can't give yourself an 11.52, 11.53 risk and then do what I did, I think on my first trade today, where I let it go all the way up to 11.60 and then try to change my mind. That's not what you want to do.
One of the real keys in understanding that is understanding what actually happens. Why do you think you need to get out there? The reason you think you need to get out there is because that's where buyers are stepping in. And that's really what you need to understand. And you can't fight the trend. If the buyers want to step in, the buyers are stepping in. Get yourself away from the bulls.
Right.
Because you will get burned.
Get out of there, man.
Nope.
We'll go over it a little bit later on the slideshow, but there's this very specific tells that show you who's in control, and I think that's actually what we're going on to next. Okay, so yeah, you can see it. I'm letting it test this level here. It never really broke clean. It's still holding. I maybe should have adjusted the risk here, but I can let it test We can go to the next topic here, which is highs and lows in trading. Right? A stock's movement can show you a lot about who is actually in control of the stock at that particular time, buyers or sellers. One of the best ways to determine this movement is by judging where a stock is putting in highs and lows relative to previous intraday moves. Okay, so to tell you what that means, if a stock has been trending down on the day, yet finally puts in a higher low and high, you can essentially estimate that the trend may be changing. You know, the control is being switched from the buyers to the sellers, or from the sellers to the buyers. And so still, at the same time, you want to wait for breaks of previous lower highs as confirmation and use those levels as your guide for your risk. All right, so just to show you what I mean by this, there's certain intraday trends that follow the natural progression of the stock. Okay, so you can see the VWAP fade up here, and you can see the fade. Not a bad fade. It confirmed my risk, which was really nice to see. I was really happy to see that, honestly, because to be honest, as it was approaching that risk, it's not that I got like super nervous, but naturally when a stock starts to approach your risk, you're going to start anticipating that you're going to get stopped out. And it kind of shows, like I said, this level went exactly down to the very cent to my risk level. I gave myself a 52-cent risk level, or 52 cents. It was like 11.52, and it literally went exactly to that risk level. Touched it, as you can see here. You can see this upwick touching that 11.52 level, and then a beautiful confirmation. I was really nervous as it was not super nervous, but I was nervous as it was approaching that risk, just anticipating that I might get stopped out. But once I get this follow through, this big volume come in, and this beautiful wash down below these highs, before these lows right here, my confidence level went through the roof in the trade. Because I have that confirmation, which is always a great thing to see. You get some confirmation in your levels, the trade's super easy to follow. And so to touch on really what this chart is about though, is that after it did that, you can see it consistently put in lower highs. So you can see it has this move here. Here's one high. It has this high right here. The next high is lower. The next high is lower than that. The next high is lower than that. And so this is what we call a downtrending, an intraday move. This is an intraday move that is very obviously downtrending. Why is it downtrending? Because it's putting in lower highs here. Lower high, lower high, lower high. And you can effectively use the previous levels to determine where you're going to get out if it does break your risk. Like for instance, if the stock moves down here, you can make this level your risk, because if it breaks that level and actually moves above it, it's no longer putting in lower highs. It's going to be putting in higher highs if it breaks this level after this move. And again, it moves down here. You can use this level as your risk, because if it breaks that level, it's putting in a higher high. It moves down. You can use this level as your risk, because it's effectively putting in a lower high, lower high, lower high. You see these lower highs, and you can essentially use the previous move as your risk. And this happens a lot. This is kind of a natural progression in the stock, like we always say. And so once we get to this move here, and we get another big move down, at this point, if this stock puts in a higher high right here, like for instance, if this stock moves down to this level, and then pushes up and breaks this and moves up here, then that's putting in a higher high, and that can be your cue to get out of the trade. And you can use that level to kind of naturally progress the stock in your levels. And so you can progress in your risk, and you can progress in your reward, where you're going to take profits. And so the beautiful thing is that, again, we get confirmation in this move. It puts in this high here, confirms it 3 times here, and then once it confirms it, you get a big downward move. Why do you get a big downward move here, guys? Does anybody know why you get a big downward move? Right, the sellers are in control, and they are pushing the stock down. People can see the downward trend. So every time we get a downward move here, long holders are selling their positions. And so we get another down move. And more long people are stopping out and getting out of the trade, making the stock push down more. And more short sellers like us are jumping in on these dips, on these pullbacks. And so the sellers are in control. The buyers are having to get stopped out, and the sellers are shorting the heck out of it. And again, when we get this big confirmation here, you hear the very common saying in stocks, double top or triple top or whatever. This is a triple top here. Even if you do one, two, three, triple top. And so people see that and they say, man, if I get in short here, my risk is super obvious, especially on this move. Because if it breaks this level, then that's a very easy exit. It's a super defined resistance and support level. If it breaks this level, it's just an easy trade. You could set this level as your risk, get in with a tight risk, big reward, and write it down. And that's why you got to think that trading is based off of psychology. It's all psychological. It's what's going on in the head of these traders. And that's why you can kind of use these levels as your guide and understand these levels and why these type of moves happen. And so again, if you do let it test your risk level, if you do let it test and it holds, which is good for you, then you can use that move as a very obvious exit at that point. It was already your risk, but now it's confirmed that level. And so if it confirms that level and it actually breaks it this time, super easy exit. You can see a previous low here, a move back up, and then another higher low at this point. And so at this point, when it's putting in a higher low here, you could see maybe the intraday trend's changing. It actually put in a higher low here. You don't want to just jump the gun with it. But now, if it breaks this level here, super easy exit. You could just get out of the trade because that's what the chart is showing you. You could see lower high, lower high, lower high. Once it puts in this higher low here, maybe the trend of the stock is actually changing. Maybe the trend is going into an upward trend instead of a downward trend. And you really have to be strict with this risk level right here because at this point it's putting in a higher low. You have this very obvious risk level, and if it breaks that, that should be your cue to get out of the trade. And again, what do we get when it finally does break that risk level, guys? We gave that level as our risk, and what happened? Once it actually broke that predefined level I gave myself as my risk, what happened? This thing just shot up. And this is why it's important to follow these levels, is because you understand who's in control, and when it actually breaks these predetermined levels that we mapped out, look what happens. The stock just shoots up. And this is the whole point of giving yourself those very defined risk levels, is because you can avoid getting caught in a big move like this. You can avoid having to hold it through a big move like this, simply by mapping out these levels and understanding these levels.
One of the keys in trading is kind of staying in that now moment. And the only way you really stay in the now moment is you stop thinking about trading and get back to worrying about the levels and just taking the trade because it matches levels, and not so much in that you're trying to believe in your trades or expect them to win. That's all it is. Let's
Right.
get back at it.
And honestly, if you think about it like this, even if you just look at these charts, right? But there's tons of strategies here that you can create basing it off of these levels. Like if you go back in time here, like if I rewind a little bit, say you're in this stock, right? And you see it confirm this level, like I said. You could essentially jump in short, setting this level as your risk. Very tight risk, give you this low here as your reward. Really great risk and reward for that short play. Just looking for the rejection of this big resistance level. It confirmed it multiple times. You get multiple confirmations. Very obvious risk level. You can make a trade based off of that. Or you could make a trade based off of bounces at this support if you wanted to. But you can create your own trades and strategies based off of these type of moves, and all you essentially have to follow is the support and resistance on the chart and just use that to guide you. You're going to find situations where the risk and reward is beneficial for you. Just buying it on these little pullbacks and these little dips because it's there and it's following the natural progression of that stock. If it's putting in lower highs, you can base the previous high as your risk. Super tight. If it breaks that previous high, it's not putting in lower highs anymore. It's putting in higher highs. And that's your cue to get out because that's the trend changing. And so you can use these levels to really guide you in your trades.
Definitely. At the end of the day, that's what we try to tackle.
Right.
That's what all our strategies consist of. They're range-bound trades. And that's what day trading really is.
Exactly.
You're trying to trade at range and be in and out of a trade within the intraday market. And that's what you're doing. So that's what you got to take advantage of. If your strategy is not to scalp, then you're trying to tackle the whole range.